If you had £500 a month to invest in 2026, most advice would either overcomplicate it or send you chasing returns. I'm going to show you exactly where that £500 would go, what earns its place, and what doesn't. This isn't theory, it's execution. By the end of this video, you know exactly how the £500 is split and what makes the cut in 2026 and the popular options I'm deliberately not touching. Quick warning, if you're looking for a clever plan, you can click off now. This is the boring plan that actually survives real life in the UK. I'm not motivating you, I'm not optimizing your life. I'm showing you a clean setup that works whether markets are calm or have gone crazy. You don't need to have watched anything else for this to make sense. Let's talk about the number. £500 isn't magic. It's not special, it's not a target, and it's not a requirement. It's useful because it's realistic. For some people, this is £300. For others, it's £1,000. The biggest mistake people make isn't the number. It's changing the plan every time the number changes. This setup works because the logic stays the same, up or down. This £500 has 3 jobs, not 10, not everything at once. 3. It needs to protect you, grow quietly in the background, let you live your life without sabotaging the other 2. I'll give you the exact split in a minute, but first you need the jobs, because once you understand the jobs, you stop second-guessing the numbers. Here's the map. Security, growth, lifestyle. These are the only 3 buckets that matter if you want consistency. And we start with the one most people underfund, then regret later. Let's be specific. Out of £500, £150 goes to security first. Not because it's exciting, not because it has the highest upside, because without it, everything else becomes fragile. Security money exists to absorb shocks, buy you time, and stop small problems becoming expensive ones. If security is weak, growth becomes a fair weather hobby. The first bad month wipes you out. Security money is deliberately boring. It's there to handle unexpected costs, income disruption, and short-term stress. If it can't do that job reliably, it doesn't belong here. This is the bucket people rush past and then wonder why investing feels stressful. Once security is handled, we move on. The second bucket is growth. This is where money works quietly in the background. This is not about excitement, it's not about trends, it's not about stories. Growth money has one job: to compound without needing you intervening or making any decisions. So here is what qualifies the growth bucket. For this £500 setup in 2026, a growth bucket means a low-cost global index fund held inside a stocks and shares ISA. That's it. No stock picking, no sector bets, no constant checking. If something needs regular attention, opinions, or timing, it doesn't qualify. Out of the £500, £300 goes to growth. Not aggressively, not cleverly, just consistently. This is the engine of the setup. Here's what doesn't make the cut in 2026. Individual stock picking, trading apps, thematic or hype-driven funds, hot tips, anything you feel the urge to check daily. Not because these never work, but because they add complexity, emotion, and interference into your life. If something competes for attention, it competes with consistency. And consistency is the real return. I'm serious here. A lot of my colleagues and friends have taken money from their global index fund and put them into meme coins. This is what happens to your consistency when something competes for your attention. Now let's deal with the bucket people feel awkward about: lifestyle. Lifestyle spending is not wasted money, It's controlled money. Out of £500, £50 goes to lifestyle. Lifestyle isn't the enemy. Unplanned lifestyle is. If lifestyle isn't given a lane, it steals from security or growth quietly. That's not a discipline problem. That's a design flaw. This £50 is the pressure valve. Without it, you end up stealing from growth and calling it just this once. This isn't about restriction, it's boundaries. Lifestyle money is allowed to be spent fully without negotiation because the important things are already handled. If you pretend you're a robot, you'll quit. This setup assumes you're human. So the full £500 looks like this: £150 to security, £300 to growth, and £50 to lifestyle. Nothing clever, nothing exciting, just clean, repeatable execution. Now let's talk about what doesn't make it, because this is where most people leak time, money, and energy. Anything that requires constant monitoring, depends on frequent optimization, or makes you feel clever gets excluded. Not because it can't work, because it doesn't survive real life. If an option regularly makes you feel anxious, overstimulated, or reactive, it doesn't belong in a boring £500 system. Emotion is a cost. Most people forget to price it in. If you have anything with no clear job, and if money isn't assigned, lifestyle will assign it for you. This setup works because it does three things well. It reduces decisions, it survives bad months, and it scales automatically as life changes. No heroics, no constant tweaking. This plan isn't designed to impress you, it's designed to outlast you. The test isn't, is this optimal? The test is, will I still be doing this in 3 years? If yes, it works. If no, it was too clever. If you want to understand why this order works so well, there's another video where I break down how the first touch of your money matters more than your income. But even without that, if you implement just this split, you'll already be ahead of most UK investors in 2026. Simple, boring, effective. I'll see you in the next one.